A professional sports franchise can lose every game on the schedule, alienate its fan base, and bleed cash, yet the team's financial valuation will still climb. There is a common assumption that these teams survive on the margins of daily operations, selling game tickets, stadium hot dogs, and replica jerseys to the fans. Relying on that volatile retail income would make a sports team a mediocre investment. If an owner's survival depended strictly on game day weather and concessions, the business would be far too risky for the millionaire class. Ownership centers on the acquisition of a legally protected monopoly. The actual athletic competition is merely the visible front for a much larger financial structure. This is the ultimate high-stakes financial game. Owners weaponize artificial scarcity to extract wealth from external systems, ensuring the value of the team grows even when the players on the field fail. This extraction begins with the invisible flow of broadcast signals reaching millions of households simultaneously. In leagues like the NFL, television contracts are centralized. The league signs multi-billion-dollar deals and distributes that money equally to every owner, regardless of their individual team's record or local popularity. These guaranteed payouts are so massive that an owner can often break even before the first fan enters the stadium. This collective leverage covers everything from video games to apparel. When Nike signs a league-wide deal, every owner collects a licensing fee without having to manufacture or ship a single physical product. Negotiating as a unified monopoly shields owners from the risks of the free market, guaranteeing a baseline of immense profitability. Beyond media rights, owners exert leverage over the physical land they occupy. This is the paradox of sports ownership. Billionaires frequently use public tax dollars to finance their private stadiums. The American closed league model is structurally different from the European open system. There is no promotion or relegation. This structure creates a hard cap on franchises. A new competitor cannot simply enter the market. Owners use this geographic scarcity as a threat. If a city refuses to fund a new stadium, the owner can move their irreplaceably rare franchise to a rival city that is willing to pay. History shows how effective this leverage can be. The Brooklyn Dodgers abandoned New York to secure 300 acres of raw land in Los Angeles, leading to the construction of Dodger Stadium. Owners also benefit from tax loopholes like paper depreciation. They can claim massive tax losses on the declining value of their player roster, even while the team is generating millions in actual cash flow. This relocation threat transforms civic pride into a financial tool. It allows private owners to shift the costs of their buildings to the public while retaining all the revenue for themselves. The most successful teams operate as global entertainment brands. They monetize fans in foreign countries who may never set foot in the local arena. While a stadium has a fixed number of seats, international media rights allow a team to scale its audience to millions of digital viewers across the planet. However, managing these global brands requires immense financial discipline. In the early 2000s, Leeds United tried to buy their way to success by outspending their revenue, a strategy that led to financial collapse and years of instability. Florentino Perez took the opposite approach with Real Madrid. He transformed the club into a global entertainment empire, focusing on star power and international commercial partnerships. This level of devotion is built on over a century of shared history and community identity. It functions as a cultural inheritance that a new business cannot simply manufacture or buy. Global clubs monetize this absolute cultural scarcity. They provide a sense of belonging and identity that remains constant regardless of the score on the field. The primary source of wealth for a sports owner is explosive, long-term asset appreciation. Mark Cuban purchased a majority stake in the Dallas Mavericks and later sold it for billions, realizing a massive return on investment that had little to do with annual operating profits. Professional sports operate outside the traditional constraints of capitalism. Because the underlying assets are so rare and the demand is so high, these teams are largely shielded from market failure. Consider the intensity of the fans. They remain loyal through decades of losing seasons, passing their allegiance down through generations. Customers abandon failing businesses, but sports fans do not abandon their teams. This irrational, persistent loyalty ensures the franchise remains a compounding asset. insulating the owner's investment from the usual risks of market rejection.